Welcome to everyone who's joining us today. We're going to give it just a minute to let everybody load in. Thanks for joining us. All right, it looks like most everybody's in. Welcome everyone. You've joined Cooper Norman's webinar, Understanding Upcoming Tax Reform. I'd like to turn the time over to our presenters, Tim Anderson and Dan Pack.
Thanks, Cody. Folks, we appreciate you taking time out of your busy days to join us for this hour. There's a lot of active items that are in play right now with legislation, with potential tax reform, with existing tax reform. Tim, I hope today we can move through as much of this as possible. And as clients have questions or concerns of the things we discuss, I hope we can circle up with them on the back end of this webinar.
And I hope people don't feel like we're leaving them with a lot of ambiguity. My goal is that people have some real takeaways, definite things they can do, looking to the last quarter of 2021, and things to watch for in the upcoming weeks.
Absolutely. I've told you my favorite part of the year is tax planning. I think this is a great segue into tax planning. Talk about things we could potentially anticipate, whether starting during Q4 of 2021 or into 2022, perhaps even 2023. So with that, Tim, I think there's a couple things that if you're trying to frame or understand what's going on right now with tax legislation, we need to understand what's happened so far. Obviously, President Biden's been placed in office. He has a piece of legislation that has been crafted but not legislated upon quite yet by the House or Senate. That's known as the American Families Plan. He articulated a lot of things that he wants to accomplish from a tax reform standpoint with that piece of legislation. And there's also in play an infrastructure bill. Tim, could you tell us a little bit about this bill and at least what we know about it so far?
Yeah, so two major pieces of legislation that are currently in Congress. There's been a lot of discussion as to what both sides would like to see happen. They even went so far as to publish something with the Treasury saying this is how we're going to begin to quantify it. But as of yet, the only one that has any specific language that's an official bill is this infrastructure bill.
Got it.
And it's the $1 trillion bill that everybody's heard a lot about.
Excellent. So, a lot in play here. Certainly these two bills are going to have to work with one another to accomplish really their respective goals. I'll add to it as well that this is a kind of a unique time right now. We're coming up on midterm elections. Obviously, we've heard a lot of narrative around potential tax reform, but the Democratic Party is going to be incentivized to maintain a dominant position in both the House and the Senate. And I think it goes without saying that legislation, whether related to tax or not, can have bearing on votes. And so it's fair to say that, this is a very tumultuous time to try to predict what our tax reform will be. I'd say there's probably three things to really be aware of when we're trying to speculate on what tax reform will be. First is the campaign promises that were made by President Biden. Number two, what is known as the Green Book. It's a Treasury Department document that's really crafted. It's not designed to be really a political document, but it sure reads like one a little bit, where they outline, tax reform initiatives and how those initiatives accomplish their budgetary initiatives that they have or their goals that they have. And the final thing is just the American Families Plan that's been crafted as well. So throughout the presentation, we're going to be talking about where we've heard maybe some of these rumors of reform, and maybe that'll help us place some weight on our confidence on whether or not we think it will actually become law.
And I think the next 3 weeks will be critical to watch as Congress comes back from their fall vacation. There are a lot of things that have to happen in the House and the Senate to get things wrapped up.
Absolutely. So with that, Tim, let's start with some easy ones here. On the campaign, Biden made mention of returning to a top tax bracket of 39.6%. This sounds familiar. This is the same top tax bracket that we had, during Obama era tax reform. Additionally, he's said often that he has no intent of raising income taxes for individuals that make less than $400,000. That was a buzzword that I remember frequently on his campaign trail. $400,000. If you make less than that amount, you should expect no change to really your overall effective tax rate. So campaign, we heard that he made good on that campaign promise in the American Families Plan by proposing a 39.6% top tax bracket with individuals entering that top tax bracket if you're married at around $509,000. Right now, that's at 628. So, by exposing yourself to that top tax bracket a whole $120,000 faster, I think certain taxpayers are going to feel the brunt of this increase in the top tax bracket.
Well, and I think as we go along, we'll see that it's not only that income tax bracket increase, it's the reduction of deductions in other areas, the reduction of credits that's really going to put a lot more burden on these people that are making 400 and above.
I agree 100%. It isn't so much a change in the rate, but these other phased out deductions that we've enjoyed in the past that will get you to that top tax bracket a lot faster. There's been a lot of narrative, Tim, about capital gains as well. What have you been hearing and what do you speculate on related to capital gains? I think I'd probably answer capital gain tax concerns from clients more often than anything right now.
Exactly. I think there's been a lot going on. I mean, in the recent past, we've had billionaires explaining that their effective tax rate is much lower than the average man's because long-term capital gains enjoy a preferential tax rate. Typically, if you hold an investment for more than 12 months, the most you're going to pay from a federal level is 20% on that. During the Bush era, it was as low as 15%. So I think from a campaign promise, it was an easy target to say, we're going to go after some of these wealthier people who live off of their investment earnings and make them pay the same as everybody else.
That's been my recollection as well. I recall during that campaign narrative, there was other candidates that were proposing 70, 75, 80% capital gain taxes. 40% sounded, palatable at the time, but certainly now a doubling of that rate, I think is something worth planning around. Now, that causes us obviously to speculate about when and if we think this will be placed into effect. Like, for example, if a client were to say, I anticipate the effective date of this capital gain hike to be 1/1 of 2022, that would certainly motivate perhaps some decision on where to experience maybe a capital gain or a capital gain transaction, perhaps accelerated into 2021, or maybe existing installment agreements that people have that generate capital gains, looking into options on exercising the remaining principal balance on those installment notes.
Yeah, I would say flexibility is the name of the game today. If you are considering making any sales in the next 6 months, it's certainly worth looking at to see how you could structure this to get the most flexibility. It could be that having it fall in 2021 would be well worth it to save the tax.
Absolutely. There's going to be concern about retroactive application of not only this, but about everything we're talking about. Oftentimes I've had clients asking, well, can they make it effective as of 1/1 of 2021 or effective as of, let's say, April of 2021? What's your read on this? Obviously, neither one of us know really on how that would play out or whether or not retroactive application would come into play. I think history would really be our only leading indicator of whether or not we think it would happen.
I honestly feel like it would be political suicide to do anything that would negatively affects the American taxpayer if you did anything retroactive and caught people unawares.
I agree. We've seen retroactive application of certain tax laws, but generally they're for the advantage or to the benefit of the taxpayer. Changes in depreciation being a great example of that, where we saw retroactive application of a tax law that was only really to the benefit of the taxpayer. This certainly would not be to the benefit of the taxpayer, but retroactive application would certainly allow the service and the Treasury Department to hedge against taxpayers. I'm not going to say gaming it, but planning around it.
Well, or blowing up the markets for that matter.
That's right. I mean, I can only imagine what Q4 would bring, what a Q4 market performance would look like, knowing that a doubling of the capital gain rate was about to happen.
I'll also make a note here that in the last 24 months, we've seen a lot of legislation in light of the pandemic to rush tax ideas or proposals, maybe without thinking through the mechanics. And now we're starting to see a lot of those problems pop up. Right now, as legislation is proposed surrounding the capital gains rates, the current administration is proposing that all long-term capital gains for people who have gross earnings of $1 million or more be taxed at ordinary income tax rates. So $1 million is the cutoff. Last week, a representative of the U.S. Treasury said that $1 million applies to everyone, whether you're filing single, whether you're filing married, head of household. And so definitely would have a huge impact on how sales are structured. Again, if you're contemplating a sale, you may want to watch how this plays out in the next few weeks to see if there is a way, to get around some of the increase in tax, especially if you're considering having income of over $1 million.
Absolutely. You're going to see it's very common in current tax law that there are different thresholds based on whether or not you're married or a single filer. For example, you'll enter the top tax bracket as a married filer, much later than a single filer will. But where they're setting that $1 million threshold on capital gains across the board without any regard to your filing status, this may be the first time in a long time that we're going to have conversations about not only how the sale is structured, but the filing status of certain taxpayers as well. Does it make sense to file married filing separate? Historically, that's been a terrible idea, but this may be an instance where we see that.
And can you retitle the property solely in the name of the spouse with less income and then file separately so that they can be under the $1 million threshold?
Add to that the complexity of whether or not you live in a community property state. Like you've said, there's these aspirational ideas and budgetary initiatives that when you build the infrastructure around the actual application of that law, things become complicated. It's complicated to say that everyone enters that at $1 million. Something needs to be said. Now, there's other things, Tim, that are being changed. I want to save some time for us to talk about some really heavy hitting items for self-employed individuals. But for individual filers, we're going to see potentially a reinstitution of the PEAS limitation. This was a phase out of itemized deductions. Idaho filers, California filers, to be limited on how much state income tax you could deduct on your federal tax return was heavy. That was a pretty punitive thing. We're going to see an ability to deduct your state income taxes again, but based on your adjusted gross income, a phase out of how much of that you could actually deduct.
Okay, so keep that in mind as we circle back here in a minute.
Agreed. Other things we're going to see is favorable changes for lower income taxpayers, things like the child tax credit. We've had some taxpayers or clients that have been receiving advance payments on this child tax credit. Oftentimes I'm hearing from clients saying, wow, I wasn't expecting this check, or do I send this back? Do I cash it? Are you getting similar questions as well? What are you telling clients that say, what am I supposed to do with this?
My pat answer is, with your 2020 tax return, 2021, this will all be reconciled. And we will apply that as, to reconcile you with the federal government. So if you take it in advance, it's just an advance on a refund you would have received for 2021.
So cash the check, recognize that it will reduce in a reduction of a credit you will get when you file your 2021 return, but you're not doing yourself any harm in cashing that check. You and I were talking this morning, and you mentioned that the Treasury Department or the service intended to send out letters that outlined all the federal incentives a taxpayer has received. Can you tell me a little bit more about that?
This was similar to a letter that they sent out for 2020 that outlined what stimulus payments people had received during the calendar year. They're going to do the same thing this year. And if you think about all the programs that we've been involved with, and all that has to be reconciled on the 2021 tax return. So I would hope that everybody would kind of tuck that away as a reminder. One of the critical pieces of information that you need to give your tax preparer this year is that letter that reconciles what you received and when.
Agreed. So watch for that letter, send that to your tax preparer once you receive it. Dependent care credits, historically, Tim, we've seen that be limited at about 20% of the total amount paid for dependent care. They've talked about ratcheting that up to 50% instead. So for households that have two spouses working, more credit available to those that are paying a caregiver for their children. Enhancements to the earned income tax credit, healthcare credits as well, for those that are on the market and perhaps receiving credits or paying penalties historically, depending on their adjusted gross income for receiving healthcare subsidies. We're going to see a lightening of that as well that I anticipate. I think regardless of what happens, I think we'll see a lightening of that. And finally, student loan forgiveness. This is one of those things, Tim, where on the campaign, it sounded so good, right? I mean, we're talking about forgiving up to 50K of federal loans across the board and 20-year repayment plans that result in forgiveness of any remaining principal balance. It sounds great on the campaign trail, but ever since being placed in office, nothing's been said about this. And I think you're seeing a lot of Republicans and moderate Democrats that are trying to hold the president accountable to the things that he said on his campaign trail.
Is there anything actionable right now that you would recommend people do?
Yeah, well, I think that there's a lot of people right now saying, oh, I want to pay down my student debt aggressively. I'd say, well, let's maybe hold up a few months and see what happens, right? I mean, because maybe aggressive repayment of student debt may not be advisable depending on maybe some forgiveness programs they put in place.
Or maybe go out and get a student loan.
There you go. Get a loan with the potential that it could be forgiven as well. Some options here to consider. Speculation at this point, but I think there's enough people wanting to hold the president accountable for that we may see something happen. 401k options. So you said before, aspirational initiative, we want to do this, but in practice, how do we do it? This is a perfect example of that, Tim, where we have this, what they are calling the creation of an automatic 401k for employees that do not have an employer-sponsored 401k plan. An ability for them to make contributions to a federally initiated 401k. I have no idea how this is done. It sounds a lot like Social Security. What are some of your thoughts surrounding this, or if we ever really see this getting legs?
I mean, to be honest, I'm not hearing a lot of conversation about this simply because I don't think it's a revenue generator. I mean, I think it's a worthwhile conversation for retirement. I just see so many to administer what would be a nightmare.
I agree. I think if they are interested in having taxpayers participate more actively in 401ks, we may see changes in the requirements surrounding employers actually providing that, perhaps lower thresholds on the number of employees that you have before they expect you to do so. We may also see maybe some relief associated with the filing of the upkeep of a 401k plan. You have to have a TPA and there's annual filing requirements. We may just see a lessening of the burden of having a 401k. Go ahead.
Or enlarging the retirement credit.
Agreed, making it a greater incentive to have one. One other thing that was mentioned was defined contribution plans. These are plans that certain taxpayers can contribute a large amount to every single year. We don't see a lot of taxpayers able to participate in these just based on, the discrimination testing, the census reports that kind of require the employer to pay a lot of money to employees as well. This is one of those we don't see a lot of, but they've indicated a desire to quote unquote clamp down on these plans, make really these, I guess, high income earners less capable of participating in these plans, replacing maybe the deduction with a credit instead. In my opinion, Tim, I think we're just going to see more invigilation over whether or not someone can have that plan in the first place.
Agreed.
What if you're a physician, for example, that let's say, works exclusively for a hospital, but you're self-employed, there's going to be probably some additional oversight added to whether or not that individual should have a defined contribution plan. C Corp rates, not a lot of clients have C Corps, but 28%. What are some things come to you? I mean, you don't have a C Corp, Tim, but why would this be interesting to you?
And I would guess that most of the people participating today probably don't own a C corporation. But I think this trickle down theory, once corporate rates go up, ultimately the consumer is going to have to pay for it. It represents a huge increase.
It does. We're presently at 21% right now, up to 28, kind of splitting the difference between where we were 4 or 5 years ago at 35%. But you're right. I mean, your publicly traded companies, your large, contributors to the economy are C corporations. So it will have an effect there. Minimum 15% tax on those that report book income of $2 billion. They're probably thinking about a few specific companies on this one in general. I really just think that it will be fascinating to watch their earnings report, for the stock exchange.
And there are still incentives globally on where to locate your business.
There you go. So maybe this will have an unintended effect, perhaps, on where people headquarter their operations. That's a good point, Tim. Do you have many clients that have done there's this credit, this historic tax credit? Have you had many clients that have ever done that?
I can't say that I have.
I can count on one hand how many clients I've had do this credit. It's a lucrative credit. It's a good credit. It's a very difficult credit to procure. It requires, state involvement. There are committees that the governor has appointed that help taxpayers get these credits. There are more credits like this historic tax credit that are being put in play right now with proposed legislation. Most of them focused around gentrifying residential areas that historically perhaps have not attracted investment dollars. So we're talking about maybe multi-family housing in very specific areas that the governor has dictated. I think it's fair to say that while this is not going to have universal appeal to our listeners today, it should be said that if we have real estate professionals that are engaging in real estate development or improvements to residential real estate, this is a good question to ask.
Well, in light of what's happened in the Rocky Mountains due to land values, I think there's going to be a big rush. I mean, especially to gentrify some usually overlooked areas.
I agree. So the takeaway here is if you're developing property, particularly residential real estate, ask key questions. Where is it located? Is it in a designated area that the governor has said is a community development, area? Is it in a historic district? I mean, those are just good questions to ask, because if they are, it'd be helpful probably to make contact with these governor appointed committees earlier rather than later in that process. Work opportunity tax credits. Tim, I have a handful of clients that do these. Do you have many that utilize these as well?
I do. And I remember when this was introduced a while back, and it's slowly been gaining popularity. But I would say this is a credit that's usually one of the most overlooked. And it's really going to save you in your payroll taxes. If you're hiring certain people from society that fit into one of these categories, and the government continues to enlarge the buckets of these categories.
They do. One of the proposed areas of enlargement is including spouses of military individuals, whether veterans or active military. So you're right. I mean, widening application for a lot of our employees, a lot of employers. My concern, Tim, is that because these are sometimes difficult questions to ask employees, that employers are less inclined to participate in this credit. Are there workarounds that come to mind for you to maybe allow employers to maybe better poll their employee base to see if they qualify?
I think so. I mean, this does impose a certain amount of discomfort and, borderline legality on what you can ask a person. But I think once you've decided to hire somebody and made them an offer, it would be easy enough to present them with a list like this and say, do you qualify for any of these? Don't specify to me, but do you qualify for any of these? Because there are certain tax credits available.
Certainly. So with existing base, perhaps just making it as non-invasive as possible, providing a very large list similar to this slide right here. Do any of these apply? If they do, great. That helps us, further our tax strategy that we have as a business.
Exactly.
I like that. I'll include in this too, Tim. There's a proposed credit, Made in America credit, a real red, white, and blue credit there at 10. It sounds a lot like the old domestic production deduction that we had in place a while ago, but it's a credit focused around either repatriating activity, commercial activity here in the States, expanding existing domestic operations, or retooling any of your operations as well. We don't know a lot about this credit, but I have a feeling this one's going to get legs.
I agree. I mean, anything that brings back manufacturing to America, production.
Right. So during tax planning this year, this would be a good thing to talk to your CPA about, saying, hey, I heard about this Made in America credit. What developments have we seen on that end? Is there maybe even some engagement we can have with maybe some of our local representatives in encouraging this credit to further?
And this is one area I could see them doing retroactive enactment.
That's a great point. This would be a good target for that. All right, so QBI deduction, also known as the pass-through deduction, the 20% deduction. It has a lot of names. I've loved this, Tim. This has been such a fun thing for clients to have this last 3 to 4 years. For those that don't remember, if you're self-employed, in general, you've been given a 20% reduction in your taxable income by virtue of being self-employed. Of course, there's limitations and thresholds that are always in place. medical professionals, for example, there's been certain thresholds that you have to meet in order to get this deduction. But gosh, this has saved clients tens of thousands of dollars in tax across the board. And seeing this go away would be tough.
Now, I've heard a lot of talk both ways on this.
Okay.
Some of these groups that have been targeted with the qualified business income, like medical professions, accountants, engineers, are lobbying to have it expanded to apply to all businesses. And like the slide points out, that there are people who are lobbying to have it restricted. Right now, if you actively manage your own real estate projects, it qualifies.
Mm-hmm.
And there are people that would want that banned because, you're more passive than active quite often in those arrangements. But I would see something definitely happening here.
I agree. In the American Families Plan, President Biden outlined again his $400,000 threshold. He's put in place again his promise he will not raise taxes, but that includes not taking this deduction away for those that make less than $400,000. My gut tells me that if anything does change here, it will likely be an overall ceiling saying if you're making over $400,000, you will not qualify for this credit. Without any changes to depreciation or other things like that, with some good tax planning, taxpayers could potentially hit that threshold on a go-forward basis.
And here again, if a taxpayer normally makes more, this is an effective increase to their tax. Again, it's not just a 2% increase to their bracket.
A good example of that is that, those individuals, let's say right at that $400,000 threshold, if they take this away, we're talking about a $60,000 to $65,000 deduction being removed from their 1040. The effective tax rate of that is at least $20,000 that you'd be missing out on. Add to that an increase in the top tax bracket as well.
Yeah, this has big social ramifications.
Yeah. Another one that bears very large social ramifications is 1031 exchanges. This has been around, gosh, it feels like since Adam. It's been around a long time. Real estate professionals utilizing the ability to take the proceeds from the sale of one property and roll them into another property so long as it's like kind, meaning that it's business or investment related. It's been such a wide, it has such wide application too, where you could even go from, let's say, a apartment complex to raw farm ground. I mean, just so long that it has either business or investment merit. To take away 1031s, its effect would be dramatic. The Green Book mentions taking away 1031s. The AFP talks about taking away 1031s. Was not actively discussed on the campaign trail. I wouldn't have expected it to be, but losing 1031s, I think, presents, number one, a big planning need for taxpayers that either have funds presently in 1031 escrow or those that are planning to sell property and hoping to find an accommodating property into Q1, potentially spilling in Q4 and potentially spilling into Q1 of 2022.
Well, and especially in this raging market. Again, people that have seen such an increase in their real estate values have got, this is a major part of their strategy.
Absolutely. So coming into tax planning, I think key takeaways, Tim, at least on my mind, and please add to this, but if you have a property that has appreciated, like you've said, dramatically in value, and you feel inclined to sell this property where historically you haven't, a couple things to bear in mind. If you can execute a 1031, do so before enactment of this tax law and make sure that the replacement property you identified is something that you probably want to hold on to, right? No telling whether or not 1031s will come back, but make it a property that you like, because the worst case scenario would be I've 1031'd into a property and now I'm potentially subject to a 40% capital gain rate in subsequent years. Find a property you like, right?
That's right. Or as you're making your decision, suddenly the 20% hit on it doesn't seem so bad.
All right. I've said that more often actually this year to clients than I ever have in the past, saying, gosh, 20% isn't that bad when you have to stare down the barrel of a potential 40% rate. Any other takeaways, Tim, that come to mind on 1031 exchanges, things that clients should be sensitive to?
No, again, flexibility.
Okay.
Build flexibility into your plan.
I like it.
I would just say on that note as well, there are ways to incorporate an installment sale. And the installment sale rules with the IRS allow you up until the time you file your tax return to decide whether or not to recognize all the gain up front or recognize the gain over time.
Right.
So we could conceivably buy ourselves another year until we make that decision.
I like it.
If
That's
you're
a
going
good
to sell
idea.
something before the end of the year.
Perfect. All right, estate taxes. It seems every 4 years we have to have heavy conversations with clients, right? Estate taxes are perhaps the most mercurial part, ever-changing part of the tax law. It's unfortunate because so much rides from the perpetuity of a business standpoint on estate taxes. So much rides on life insurance policies that people buy. So much planning is required for estate taxes, and it is just a moving target.
Not to mention the documentation that's involved is so burdensome.
Absolutely.
I want to say that the attorney's lobby is pushing this.
You might be right. It seems that every year for individuals that have estates that have historically been in excess of $11 million, they've had to undergo just radical planning and radical professional fees every year to prepare for some eventuality that they can't predict. I hate to say it, but I think that this is getting even more unpredictable. And the thresholds where people historically haven't had to think about it may now have to consider it because the thresholds are changing by such a dramatic degree. Tim, right now, the narrative has been if your marital estate, you and your spouse, if your marital estate is less than $22 million, or let's just say less than $20 million, there hasn't been great need for you to place a lot of weight on planning and gifting, or really think about what happens when we pass. So from a tax perspective, is there going to be a big burden when I pass? That threshold now is $7 million. So if your marital estate is 7 million or less, you should be having active conversations with your CPA, with your attorneys, your financial advisors across the board. And in my opinion, Tim, it doesn't really matter how old you are or how healthy you are, that conversation needs to be happening.
I'd agree. I hate to, sound like a broken record, but, in this real estate market, I think there are more people than ever that are suddenly going to be looking at $7 million net worth that they otherwise or have never considered that they would have.
Might have snuck up on them, right? You might have some ag producers that owned farm ground that historically never rose to that level, or real estate. But like you're saying, with it appreciating so radically, this may be a surprise to certain people that have a lot of illiquid assets.
Well, and as soon as we talk about the other proposed changes in here, I think it's going to become more of an alarm that we need to sound at this point.
Agreed. Now, Tim, we need to do a separate webinar just on this topic. There's no question, right? I mean, we're going to be talking about things like step-ups and lifetime exclusions and things that I think require some background, some understanding what they are. So let's you and I before year end do another one of these where we talk specifically about estate taxes. But that being said, let's do our best to make this as understandable within 5 minutes as possible. Maybe it'd be good for us to use an example, if you don't mind. Maybe a taxpayer, let's say that owns $15 million worth of land, let's say $10 million worth of real estate. They own a business and they have some cash. Historically, we may have been talking about gifting to children and heirs through LLCs, things of that nature. But they knew that upon their passing, that land and that real estate would step back up to fair market value and their heirs could sell that effectively tax-free.
Yeah, and what that means is, if dad leaves you a property, by inheritance, you would be treated as though you had bought that on the day of dad's passing for its fair market value. So if you sold that the day after he passed, you would have no income tax burden. What you paid for it or deemed to have paid for it and what you sold it for would be exactly the same amount.
Exactly. Losing that step up would be catastrophic. And I think that's what we're looking at right now in this example. You may have, let's say, some ag producers or land that dad owns that he's owned for 80 years, that now having to adopt dad's original cost basis and still pay, estate taxes on the fair market value of that land is a bit of a double whammy. Not only are you having to pay estate taxes on the fair market value of that land, but you have adopted dad's cost basis, meaning that when you sell it, you will recognize a gain.
And I think it's important to remember that the whole estate tax structure was set up, a century ago to go after families like the Rockefellers, who would, in perpetuity pass along this wealth. Now it's affecting the average Joe. And this would be particularly burdensome if you received property via inheritance from your parents, let's say, and then suddenly you were looking at an income tax gain if you ever sold it. There are people that are proposing a transfer tax so that upon inheritance, you go ahead and pay for the appreciation. So there are big things coming in this area, I would say.
Got it. So potentially losing step up may encourage individuals to gift property under the current $23 million exclusion instead of waiting until it goes all the way down to potentially 7 million and losing that step up. So gifting is probably bullet point number one, I'd say, to consider right now if your estate's in excess of $7 million. Hedge against that step up by at least getting more of your estate to your heirs now.
Where does the 7 million come from?
7 million is, right now, married filing joint individuals each get an $11.5 million exclusion. In other words, you and your spouse could move effectively $23 million of your estate to your heirs completely tax-free. The talk right now is moving that all the way down to 7 million or $3.5 million apiece, where only that much could convey to your heirs tax-free. Every dollar above and beyond that 7 million would be taxed at estate tax rates, which cap out at 45%. It's rather burdensome.
And I would just add to that, listening to this, it's probably easy to say, you know what, Congress is really jacked up right now, and they probably won't get anything passed. I will remind people on this call that in 2025, if nothing happens, all of the changes that Trump made in this area are going to expire, and we're going to go back to that level anyway.
Right. So regardless, this is going to change. Takeaway from this slide is if you have a gross estate in excess of 7 million, again, regardless of your health or age, speak with your CPA. Great tax planning discussion for these next 3 months.
Or even if you've got some rapidly appreciating real estate that could push you up to that level.
That's a great idea. Any other final thoughts on that, Tim, before we leave the topic?
In practicality, what I'm doing with a lot of clients right now is we're getting some tools in place so that we can pull the trigger. Maybe we're not pulling the trigger right now, but we're meeting with attorneys, we're drafting documents, and all we have to do is sign some pages and get them recorded, and then we're in a safe place. So again, building flexibility.
Preemptive moves, be flexible. All right, deductible state income tax. Tim, you said to us, remember the P's limitation earlier in our presentation, that itemized deduction that we now get to deduct our state income taxes as an itemized deduction, but we're subject to phase out. Why is this topic so important right now?
Well, if you hearken back to prior to Donald Trump, there were limitations placed on what people could take as an itemized deduction against their income tax, their taxable income. And some of those were phased out. One of them was taxes. You can take a deduction as an itemized deduction. You can take an itemized deduction for property taxes, state income taxes, irrigation tax, ad valorem tax on your car, but those would be phased out as your income got higher. The Trump tax reform did away with those phase outs. Those phase outs were referred to as the P's limitation. But one thing that Trump substituted for it was a cap on state income tax deductions. He capped it at $10,000. A lot of people, especially on either coast, pay a lot more than $10,000 in state income taxes every year. And this significantly affected their tax burden. Especially our physician clients who pay a lot in state income taxes. They weren't able to deduct those state income taxes. Plus, they weren't able to get into the QBI.
Right.
They've had kind of the worst of everything. So one thing that has kind of caught fire over the last 12 months is states have started to adopt an elective tax. Businesses are able to deduct in full the state income taxes they pay. So states have started to say, we're going to allow a business, a pass-through entity business, to elect to pay their owner's taxes and deduct it on their tax returns. So therefore bypassing this limitation on the itemized deductions. So I would say that for anybody doing tax planning this year, they need to consider having their business pay their state taxes before December 31st.
Got it. So I've noticed, Tim, that a lot of states are, in they've all responded very positively to this. We've seen a lot of states put in place the ability for their taxpayers to do that. It's my expectation that the remaining states that have remained silent on this matter will by year end, capitulate and allow taxpayers to do the same. You mentioned pay before year end. We have some taxpayers, let's say, that are, accrual basis, or they may not know what their state income tax is going to be by December. We can guess at it, but we won't know definitively. Does that mean that we just pay in an estimated amount of state income taxes and deduct it at that entity level anyway?
I would say yes. I mean, if you can front end, especially some of those payments, and get the deduction now, or even on New Year's Eve, make that payment.
Got it.
I mean, it's going to save you.
Got it. I noticed that Idaho put in place just recommendations on how taxpayers can do that. They have, Idaho Form 40V. It's a payment voucher that you historically have used to pay your individual state income taxes. They've indicated that you'll just use that same form, that you'll write in your business's name and its EIN and put in the amount that you're paying on behalf of the shareholders.
They have promised us that we would see some forms soon, but they are scrambling to adopt this.
I think that's across the board, whether you're in Oklahoma, Colorado, Utah, wherever you're at. We've not seen many states prepare adequately for this coming into year end. We're going to see things probably starting in November, hopefully no later than November, because taxpayers are going to want to pay this, well before the December 31 deadline.
So a thought that came to my mind was, for the taxpayers that I've been recommending that they pay throughout 2021, their state estimated payments, what should I tell them?
Probably to make another payment right at the very end of the year that's equal to the total amount they're going to pay. They'll get a big fat refund, but gosh, this is just one of those times where you just want to follow the letter of the law that they've given you, take the refund and secure the deduction.
I agree. That's where I ended up.
That's good. Yeah, I think I'd agree with you there. So again, at 30,000 feet, if you are a business owner, you are going to be paying your state income taxes at the business level during tax planning. So at the end of this year, between October and December, you're going to be prepaying your state income taxes and it will be out of your business.
But it will save you. You'll get the full deduction.
That's right. Better than anything we've had, gosh, in recent history, right? A full deduction for your state income taxes. So love it. All right, so the big one, I think that we have most of our listeners here today because of the ERC. So this is the Employee Retention Credit. It's a credit that was in connection with the FFCRA last year, the PPP money last year, this credit as well as enhancements to unemployment. It was one of many initiatives that the federal government just threw out there saying, business owners, we want to help you survive. We want to help you make it.
And like everything else, in their haste to get this out, we've been getting the rules piecemeal. And over the course of this summer, they changed the rules on us. So I think it's important for us to focus on what they changed and what we can do. Originally in 2020, the rule was if you took out a PPP loan, you were automatically disqualified from doing the employee retention credit. This summer, they reversed and said, no, you can do both.
Yeah, just so long as you're not overlapping or claiming that same dollar for the same incentive, right? But you're not disqualifying yourself in perpetuity from getting this ERC. Add to it the fact that June 30th of this year, they put in place an enhanced ERC. So we had last year's ERC that was saying, if you're an employer that is maintaining a workforce that because of COVID, otherwise wouldn't be working, they're not performing services, we will give you a credit for 50% of their wages for continuing to employ them. That was the rules last year. And I will add to this, Tim, that if you missed out on claiming that credit last year, go back and amend 941s to get that credit. Nothing is too late at this point. Anything that was in place back then, you can still claim, okay? They've enhanced that. They've given this thing steroids and said, not only are we going to give you 50%, we're going to give you 70% of qualified employee wages that you pay every single quarter without the need to demonstrate that because of COVID, they're not performing services. So The question is, gosh, then who doesn't qualify? I mean, it sounds like everyone gets to file with their 941 a request for up to $7,000 on each of their employees that they retain every single year. So it might be helpful for us to back up and say, okay, let's have an example here and walk through it. Okay.
Good.
So Tim and I gave you the example of a friend of mine up where I live. He owns a lawn care business. Okay. He sells lawnmowers, he sells trimmers, he has a few employees as well. And I'll admit that even on the weekend, I'm thinking to myself, gosh, I wonder if these people would qualify for this credit. So he's been in operation. He was in operation throughout last year. He was subject to the governor's mandated shutdown last year. Let's say that he got a PPP loan at that time. Okay. He's been operating this year and has been very successful. He sold a lot of his inventory. But when I went in to go buy a new lawnmower, his response to me was, I can't get them. We can't get lawnmowers. Let's maybe walk this guy or this potential candidate through this credit. Okay. We know, number one, that he will likely fail number two. Bullet point number two is saying that your gross receipts, or the amount that you earned last year, this year, is, at least 20% less than it was in 2019. I'm going to say no, just because inventory levels are low. I'm guessing he's had a good year. It comes down to whether or not bullet point number one is true. Is he currently subject to a full or partial suspension of operation due to COVID right now? Governor has not placed any imposition on him right now, so I'm not going to say he's under a full shutdown. What are your thoughts about this potential candidate?
Well, I would look first to governor's orders. Governor Little in March of 2020 said non-essential businesses need to close. So I would look to that list and see if he is considered a non-essential business. I doubt he closed because I think maintenance companies, he probably does yard care, probably continued. But as you drill down, and again, remember, all we have to go on this is the frequently asked questions that they continue to release to give us guidance on how to apply this. But one of the things is you are considered to be partially suspended, your business, if you have suppliers, if your suppliers by government order are not able to give you the raw materials you need.
So potentially then this lawn care business owner would qualify for the ERC if he's incapable of getting inventory due to some governor mandated or government mandated shutdown. I don't know who his suppliers are. I don't know if they're domestic or foreign. He would likely know, but as a business owner, it would probably be wise for him to opine the reason why he cannot get lawnmowers. Is this COVID related? And if it is, he is likely subject to a partial shutdown due to COVID. Is that fair to say?
Agreed. And then from here, your imagination goes wild.
It does, doesn't it? You're a dental professional. Let's say you've had a difficulty getting latex gloves, or you've had a difficulty getting certain oral appliances. Are you subject to a partial shutdown? Maybe you are.
If you're farming, you can't get repair parts for your equipment. If you're in construction, the Canadian border was closed forever. And there was lumber piling up at the border because of a national border shutdown. I think if it were me, I would want to find the chapter and verse of the order that you're relying on, and then put together a good description of how that has impeded your normal operations.
I agree. I think good visual for this is two windows. You got a really big window and you got a really small window, right? Your big window is, do you qualify because your gross receipts have gone down, that you're making less money due to COVID? If you qualify for that, hop through that window. That's an objective truth that you qualify for this credit. But if you don't satisfy that, we're going to have to build a narrative. There has to be a qualitative conclusion that you reach stating, yes, I guess I qualify due to the following parameters. But this isn't something, Tim, that someone can go directly to their CPA and say, do I qualify for this credit or should I claim this? The answer is, well, I don't know. We need to talk about it. Talk to me about your business. Talk to me about your industry. What are your peers saying? Are they identifying partial, shutdown parameters that you should be identifying as well? You and I were even talking about CPAs as well, just recently asking, okay, well, do we qualify? And I'm not going to say we reached a solidified answer that we do qualify. I think it's going to be maybe some time that we spend reading some industry specific articles and looking what maybe some of what of our peers are doing as well.
Agreed. But I think it would behoove anybody with a payroll to be considering this and having a conversation with somebody.
That's right. Now, there is a third small bullet point down here at the bottom, Tim, called a recovery startup business. That's any business that started after February 15th of last year. If you started after last year and you made less than $1 million, you're going to qualify for this. So that's great news for startup businesses that really had no operating history in 2019. If you started up in 2020, they're throwing you a bone and saying, yeah, go ahead, claim the credit.
And it's really lucrative. I mean, just if you think in your mind about a business that started after February of 2020, grossed less than $1 million. So even if it was in the last month of the year, you can take a deduction or you can get a credit or a refund of up to $50,000 per employee.
Right. It's extremely lucrative. You're correct. Some of the thresholds that I probably want to have people bear in mind is that if you have fewer than 500 employees, which is most, if you have fewer than that amount, this can be claimed on all employee wages. Each employee, the first $10,000 that they're paid in that quarter, they can receive a credit of up to $7,000 for each of those employees. If you have over 500 employees, you have to actually recall the rules back in 2020. You have to demonstrate that those individuals are not providing service due to COVID-19. You're still paying them, but they're not providing service. That's a weird thing to have to deal with here in 2021. Agreed? I mean,
it is. But as I looked at the details on that, the measurement of these employees is measuring 2019 employees, and you're looking at FTEs. So if you're the kind of employer that you have more than 500 people on payroll, but some of them are part-time, maybe you don't have 500. I think they've opened the door to get around a lot of this.
That's fair enough. All the same, suppose that you can't meet that loophole. You have 500 and you have to demonstrate that these people are not providing service due to COVID-19 in 2021. That's hard because I think as a business owner, you will have already made corrective action for those employees, potentially even laying them off, only to now find out they still want you to hold on to those types of employees as well. This one's going to be, I think, a real tightrope walk for those that have over 500. Under 500, build the narrative and build it strong. Point to the supplier that has that governor mandated shutdown and articulate why it impacts you. Build the narrative.
Good point.
So one other thing I want to clarify, if there is a PPP loan out there that for some reason you still haven't satisfied, that you're still quantifying wages against that amount for forgiveness, it does not play nice with this ERC. I'm guessing we're well past that with most of our clients. Claim the ERC even if you got a PPP in 2020. But if in 2020 you're still trying to claim the ERC, you got to look to the PPP and determine whether or not those wages were used to claim forgiveness on a loan.
Yeah, you're just going to have to point at specific wages and say these were PPP wages and these will be my ERC wages.
Agreed. Final thing, this is where we speculate the most, Tim, but I mean, whenever we see doors kicked wide open on subsidies like this, my mind always goes to stating, is there going to be a back end substantiation of use of funds or of need that I'm going to have to claim? Because right now, Tim, when clients go out and claim the ERC, they're not attaching a narrative saying why they need it. They're not telling the IRS, hey, I have this shutdown, or the governor said this, or my suppliers have been tough. They're just writing in a number, right? I have my opinion on the matter, but I'd be curious what you think. Do you think there's going to be down the road need for these clients to substantiate why they needed that credit?
Well, I think certainly in the press, we've seen people outright shamed because these proceeds are generally public record. People that were shamed by taking government subsidies, even though they qualified through and through. So someone needs to consider that as they apply for it. whether it would be bad press if it came out or not. But the congressional committee notes did actually refer to prosperous businesses that will still qualify. And their response was, it was important enough to our economy to have businesses prosper that we're going to allow it.
I like that statement, and it forces me to have you look at the conjunction or. They're saying, are you financially harmed or are you subject to a shutdown? It's not an and, right? They're not saying you need to be in some sort of federal financial distress in order to qualify for this. You can have prospering businesses to still qualify for this. I think what's important, though, is that you build the narrative as if you are being invigilated today. Build out, this is why I'm claiming it. This is the supplier. This is what's happened. Build it today. If you can do that with comfort, you likely have merit to claim the credit. If you are struggling to do that, you likely lack merit. But again, that's not a determination their CPA will make. That is something the business owner needs to, I think, help articulate very well.
I think the CPA could facilitate the conversation.
100%. Okay, final thing, Tim, we want to talk about before wrapping up our hour presentation here is the Idaho rebate. So back on May 10th, Governor Little, I think we had a budgetary surplus, and there was some narrative of saying, what are we going to do with these excess funds? Governor Little stated that during this difficult time, he wanted to provide to taxpayers a rebate based on how much tax they paid in 2019. I think it's a weird threshold, to be honest with you, but that's a conversation for another day. But depending on how much tax you paid in 2019, there was going to be a rebate sent to you, whether by direct deposit or by check, that taxpayer would expect to see. We're talking 9% on the total amount that they paid, again, just deposited in their account without any need of applying for it or requesting it. It was just coming. Have you had clients already receive some of these funds?
I have, but more than not, I've asked people where it is.
Yeah, so I have a feeling for those that are still sitting on an extended income tax return, they likely will not see these proceeds until probably after they file their 2020 return. Although it's based on 2019, I think the indication is that they want to see a 2020 filed tax return before they give it. This will be paid all the way through the end of the year. So if you haven't received it, don't panic. You will get it. It will arrive. If by December 31 you have not received it, that's a time to ask a question. And no doubt there will be some sort of online portal in place that will allow individuals to request payment if they haven't received it.
Good.
You need to be a full year resident in order to qualify for it. But yeah, across the board, I've also seen clients receive it wondering what it is. If you see a random deposit in your account, there's a 1 in 3 chance it's this. Okay. Tim, in conclusion, is there anything else that you want to drive home? There's obviously presentations we have yet to give on estate planning that is important here in 2021, as well as tax planning that we have coming up as well.
There was one thing that I just happened to remember at the last minute. I will throw out to any of you who are working in the ag sector. Of course, Idaho has been through an extended drought. There are tax provisions for people in the ag sector who are going through extended drought. And you need to be aware of that as you do your year-end tax planning. If you are selling crops or animals prematurely because of the weather, you are given a furlough of when you need to recognize the income on the sale of those, and need to be considering that as you get into the end of the year. I'll just leave it at that and hopefully pick up more detail in a future discussion.
Thanks, Tim. With that, we will conclude today's webinar. I appreciate everyone participating. We'll make available our slides. Feel free, if you have any questions, to reach out to your Cooper Norman representative. I do this every year, but I highly recommend engaging in tax planning this year. There's a lot that I think every taxpayer could glean from engaging in that this year. So strong encouragement to do that. We appreciate all of you very much. Appreciate you as clients. And with that, we'll turn the time back to Cody to conclude the webinar.
Thank you, Dan and Tim. Like Dan said, for everyone watching, a video recording will be sent out by email. The recording will also be posted to our website and YouTube channel. If you have any questions, feel free to reach out to a member of the Cooper Norman team. Thank you all for attending today's webinar and have a wonderful day.